The Hong Kong Institute of Chartered Secretaries recently held its 10th biennial Corporate Governance Conference, focusing on the theme Corporate Governance Inside and Out, Forces Shaping the Corporate Governance Landscape. In the first of two keynote addresses from that conference, Professor K.C. Chan, Secretary for Financial Services and the Treasury, reviews some recent highlights in the field of corporate governance and assesses Hong Kong's performance in this area. In another keynote address, Mr. Anthony Neoh, former chief advisor to the China Securities Regulatory Commission, identifies emerging trends in corporate governance and then relates these trends to the role of Hong Kong's legal and regulatory system.
Naturally, I'm very delighted to be here today at the biennial Corporate Governance Conference of the Hong Kong Institute of Chartered Secretaries. In this 10th edition this year, the conference has brought together thought leaders from various fields in one place to explore the ever-changing landscape of corporate governance. And this year is a wonderful continuation of that great record, and I believe this two-day conference will be a very good conference. And I will talk a bit about what we do in the government and how that relates to the corporate governance professionals. And indeed, I think we have benefited greatly from your input in the past, and I'm sure in the future. Now, we in Hong Kong have every reason to attach great importance to corporate governance. As of August 2016, when I look at the number of companies registered in Hong Kong with the company register, we have 1.3 million companies registered in Hong Kong. We incorporated almost 140,000 companies last year alone, and that comes down to more than 500 a day. And despite the slowing global economy, Hong Kong retained the top spot in terms of the IPO funds raised in the world last year. These statistics are a vote of confidence in Hong Kong's corporate governance standards. In fact, Hong Kong's ranked fourth in the ease of starting a business according to the World Bank's Doing Business Report 2016, which compares business regulations in 189 economies in the world. Among these indicators, Hong Kong ranked first in protecting minority investors worldwide. And the study also commended the electronic filing service we launched last year and the implementation of a modern collateral registry to help improve access to credit. Cheers and applause, indeed, to our corporate governance regime, and it is a product of many years of hard work. For example, the Corporate Governance Review, released in two phases in 2001 and 2003, were subsumed in the company's amendment ordinances of 2003 and 2004, and ultimately in the new company's ordinance passed in July 2012 and came into operation in 2014. And we had enactment of the Securities and Futures Ordinance in 2003, followed by revisions of the Code on Corporate Governance Practices in 2005, 2012, and 2013. This year marks the second anniversary of the implementation of the new company's ordinance. Under the new ordinance, operation of companies is now more transparent and accountability of directors strengthened. There are also more opportunities for the shareholders to participate in the decision-making process of companies, and their interests are better protected. Thanks to the hard work of the industry and the company's registry, the implementation of the new ordinance has been very smooth so far. It is well received as well, since the business community is keen to take advantage of the initiatives introduced to facilitate business and to save costs. For example, around 98% of those companies which reduced their capital adopted the alternative cost-free procedure in 2015, and about 60% of company restoration cases are now dealt with under this new procedure. SMEs meetings specified size criteria are now preparing simplified financial statements and directors' reports. I would like to thank the Hong Kong Institute of Chartered Secretaries for your inputs during the consultation and your hard work making a smooth sail of the transition process. Highly regarded by international investors, our corporate governance regime has all along been a cornerstone of a financial market. Good corporate governance enhances investors' confidence and the appeal to our markets, which underpin the stability of our financial system. A Hong Kong listing has become a popular way for many companies to demonstrate to the world the accomplishments they made in corporate governance. It is therefore no surprise that Hong Kong is home to the fourth largest stock market in Asia as of the end of July. And in terms of IPO funds raised, Hong Kong has been among the top 5 globally for the past decade, ranking first from 2009 to 2011 and 2015. And to further enhance Hong Kong's business environment by giving confidence to investors and creditors, we have conducted comprehensive review of the relevant provisions in the company's winding up and miscellaneous provisions ordinances. And the relevant amendment ordinance was enacted by the Legislative Council in May 2016. The amendment ordinance will improve and modernize Hong Kong's corporate winding up regime by providing measures to increase protection of creditors, as well as streamline and enhance the integrity of the winding up process. This will also help further align our corporate winding up regime with the latest international developments. The audit profession also plays a crucial role in helping companies uphold the highest corporate governance standards. It is imperative to ensure that we have a robust regulatory regime for auditors of listed entities that is up to the international standards and practices. This is particularly important given the international nature of our financial markets and during times of economic uncertainties. The government has embarked on a reform exercise to improve the regulatory regime for auditors of listed entities in Hong Kong. The key objective of the reform is to further enhance the independence of the regulatory regime for listed entity auditors, with a view to ensuring that the regime is benchmarked against international standards and practices. And under these reform proposals, the Financial Reporting Council, FRC, will become the independent auditor oversight body vested with direct inspection, investigation, and disciplinary powers with regard to listed entity auditors, while the HKI CPA will perform statutory functions of registration and standard setting with respect to listed entity auditors under the new regime, and that is subject to the independent oversight of the FRC. In the earlier public consultation, an overwhelming majority of the respondents are supportive of the objective and the direction of the reform. The government is preparing an amendment bill for the reform and will continue the dialogue with the stakeholders in working out the detailed arrangements of the new regime. We look forward to continued support from all stakeholders to this reform. Another matter I want to bring up is that as an international financial center and responsible member of the global community, Hong Kong supports the international agenda to enhance tax transparency and combat cross-border tax evasion. We have been actively pursuing comprehensive avoidance of double taxation agreements and tax information exchange agreements with other jurisdictions. As of April 2016, 35 CDTAs have been concluded, and we are in discussion with India, Saudi Arabia, Finland, and Bangladesh, etc., for more. And since the enabling legislation for signing tiers came into practice, 7 such agreements have been concluded with our partners. We have also been actively involved in the OECD's Global Forum on Transparency and Exchange of Information for Tax Purposes. We indicated our support for implementing the standard for automatic exchange of financial account information in tax matters last September. And we plan to begin the first information exchanges with appropriate partners by the end of 2018, as long as domestic legislation is in place by 2017. And we will continue to engage relevant local stakeholders and address policy and legal issues before we seek the Legislative Council's approval. In this, we look forward to your input and support. Our intent, of course, is to meet international obligations, and in so doing, protect Hong Kong's status as a global financial center. Ladies and gentlemen, the corporate governance system is the cornerstone of the modern companies and today's free capital markets. Corporate governance structures are widely adopted in administration of many public bodies in Hong Kong and other parts of the world. The corporate governance regime is also an evolving one. I'm confident that you will make the most out of this 2 days program to brainstorm, to map out the direction for the future, and to support the further efforts in enhancing Hong Kong as the financial center, for the world. Thank you so much.
I think there are some things which I believe are important that I should deal with. I'm going to deal with just 2 things. The first are some emerging trends. There are 3 that I've picked out which are very important, which I think that boards must respond to. The second is that even if boards were to respond to some of these trends, they require the support of a good legal and regulatory system. And I'm going to say something about that as well. Let me first deal with the trends. Now, there are 3 trends which have emerged, which nobody, in fact, can ignore. I mean, just nobody. The first trend is that the digital revolution has been really been with us for a long time. Of course, you remember the internet bubble of the early 2000s. But then, of course, that has grown into far more than a bubble. It's grown into something quite solid. And in recent years, of course, new technologies have been developed. I mean, you know, of course, of the blockchain, which is very, very important. And today, of course, we now have just in my cell phone, which is here, this has more computing power, in fact, than all the computers on the moon landing, in fact, in the spaceship in the moon landing. Just far more, many orders of magnitude more than that. So therefore, we have, in fact, the functionality to deal with a lot of things, actually, within a person. A new term has been coined, which is called sort of IoT, which is the Internet of Things, as you all know. We have the electronic purse, which is now pervasive in China, and that has transformed, of course, the retail and logistics industry in China. Internet lending has, and also internet insurance has really blossomed. And therefore, really, we see that no financial institution, or indeed no institution, can actually ignore, in fact, the trends. Now, add to all this, of course, is the pervasiveness of social media. Despite, in fact, social media being somewhat controlled in China, I use the word somewhat because you can never control it, actually. And almost everybody has a VPN in China. So therefore, you can see that social media is such an important medium of communication that nobody can ignore it. Now, therefore, to call this a game changer, I think is a patent understatement. So boards must begin, in fact, to review these developments. They should, in fact, develop a program for exploiting many of the facets of this game-changing affair and really take charge. I think, therefore, directors themselves cannot just rely on the management. They themselves will have to begin to take charge. Perhaps not in a way which is totally sort of obtrusive, but in a way which I would think would be symbiotic between the board and the management. Now, that is the promise of the digital age. But the negative side of that, of course, is hacking, fraud, deceit, and so on, which is now taking place. So therefore, really, cybersecurity, as is now called, is an important subject for all boards. Not just, in fact, financial institutions, of course, particularly financial institutions, but I think for every company that has anything to do with customers, and all companies have things to do with customers, with stakeholders, and shareholders, and so on. So fraud is a very important thing. It has to be very high on the agenda of every board. Now, the second trend, even just as important, I would think, is the need to really take note and awaken to the very close scrutiny that governments, politicians, the communities at large, the financial media have of ethical behavior of institutions, not only of public institutions, but also of companies. And particularly, of course, of publicly listed companies, which are, in a general sense, of course, a public institution. And therefore, really since the mid-1970s, we actually have the first piece of legislation that has global reach. And that, of course, is the United States Foreign Corrupt Practices Act. Now, that, in fact, has now gone into an OECD international convention. We have, for example, the UK Bribery Act, which, of course, prohibits any company with any substantial connection with the United Kingdom or the United States, if their people bribe any foreign official, then they commit a crime in the United States or in the United Kingdom. But the United Kingdom has something even more, which is something intrinsic in the convention. And in fact, the United States apply it not through the Corrupt Practices Act, but through other pieces of legislation in the United States, which is that if a company, a publicly listed company, which is registered in the US, or as far as the United Kingdom is concerned, a company which has a substantial connection in the United Kingdom, for example, where a company actually has a subsidiary in the United Kingdom through which, in fact, the company does business in the United Kingdom, then that company, in fact, has a responsibility to make sure that corruption does not happen. Now, that has a preventive responsibility on a company. And to give you an example, the GlaxoSmithKline, which is GSK, you remember that there was, in fact, a corruption scandal in China a few years ago, and they were fined a few 100 million renminbi in China. Now, that was not the end of the story, unfortunately, for GSK. The GSK is now still under investigation by the Frauds Office in the United Kingdom government for breach of the UK Bribery Act, for not doing sufficiently, for not doing what is reasonable to prevent corruption in their major subsidiary in China. Now, that investigation is still going on. Many, in fact, investment banks and some institutions are still being investigated under the Foreign Corrupt Practices Act, not only by the SEC, but also, in fact, by the Department of Justice. There are a number of law firms which does, in fact, a tremendous amount of work, in fact, in this region, Hong Kong, China, and so on, really helping these companies develop programs for preventing corruption, but at the same time, in fact, dealing with the ongoing investigations, in fact, by the UK government, by the US government, through the various agencies. So we have to be extremely careful, in fact, and we do need, in fact, an ethical program within the board. And in fact, the prosecution guidelines around the world now essentially say that if a board, in fact, has done what is reasonable within the best practices band of monitoring systems and so on, they may well be given, in fact, credit, in fact, for doing so. So therefore, boards have to do enough, and therefore elevate that within their agenda. Now, bribery is not the only thing. We now have, for example, international conventions, particularly ILO conventions and UN conventions on human trafficking, and also on work hours, as well as forced labor, child labor, and so on. Now, in the United Kingdom, they have put that all together into a piece of legislation called the Modern Slavery Act. Now, other countries are now beginning to do the same thing. Hong Kong hasn't done it yet, but I bet it cannot miss out in the future. Now, as far as the UK Modern Slavery Act is concerned, any global company with 32.6 million of turnover, which has a subsidiary in the United Kingdom, will be caught. Now, companies like Esg, for example, will certainly be caught. Cheung Kong Infrastructure will be caught. Li and Feng will be caught, for example. I mean caught within the net I don't mean that they'll be caught for doing something wrong, all right? Okay. Now, so these companies, in fact, have wide-ranging, what they will call ethical compliance around the world. They look at their supply chain to make sure that they are fully compliant, and they are, in fact, therefore, what I would use the term a good corporate citizen around the world. So corporate citizenship would be very, very important in this emerging trend. Now, this trend, I can assure you, will become more and more entrenched, and the regulations will become more and more complicated, and the enforcement will be more and more fierce in the future. That is because the world is awakening to that, and it is an extremely good political thing to get votes. And you know, any politician worth his salt wanting to get votes would want to ride this bandwagon. And I'm sure, therefore, that boards would have to be extremely, extremely careful to make sure that this is on the top of their agenda. The other thing that trend which is important, of course, is environmental. You see, of course, the COP21, climate change agreements in Paris, which have now been ratified by many major countries. Recently, of course, in Hangzhou, the United States and China has ratified. Those are the two major countries for climate change. Now, that is, of course, also an important emerging trend, and where boards, in fact, cannot afford to really ignore. The good thing about that is that because environmental legislation has been around us for a very long time, and therefore many boards, in fact, and company managements have really spent time on dealing with environmental compliance. That is a good thing, but that doesn't mean it is not urgent. It means, in fact, that boards have to put this as part of their constant agenda for ensuring compliance, but at the same time, we're trying to take active steps to comply with best practices. So those are the three trends which I think boards must really think about. And all of you, of course, as being advisors of the board or being on boards themselves, really have to think about this very carefully to ensure that they do not only comply, but really at the forefront of these emerging trends. The next thing that I would like to deal with is this, is that you must ask that question, is that, well, boards cannot ignore all of these trends, but what are the responsibilities of directors and officers of companies? In fact, nowadays, officers of companies and directors are treated more or less the same. In fact, so if you're a company secretary, you're an officer of the company. And your responsibility may sometimes be even greater than that of a director because you are called upon to advise them. But then, of course, the legislation itself, they concentrate on directors. And you recall, of course, we've now got the new company ordinance for about 2 years now. And in the company's ordinance, really stand out within the new company ordinance is this new definition of the responsibility of directors. There's a section 465. Now that section, in fact, says this, that a director must exercise reasonable care, skill, and diligence. And this means that the director must exercise this with the general knowledge, skill, and experience that might be reasonably expected of a person carrying out the function carried by the director in relation to the company. Now, I know you all know this, but I would like you to underline the word in relation to the company. It means that every director, in fact, must know the company. And there is no excuse because it is all, at the end of the day, it is tested objectively, in fact, in relation to the company. So directors cannot say that, well, you know, I'm in IT, I know nothing about financial businesses, or I'm in finance, I know nothing about IT, and that there's a big IT problem or the big financial problem. Then the director cannot say, I don't know anything about it. The director will be tested that, well, you may not be in the industry, but you must know sufficient about the company that a reasonable person, given your position, should know. So that means that directors of companies, in fact, need to really spend time on knowing the company. Now, the second part of the test is even more stringent. The second part of the test says this, well, first of all, you must know what is reasonably expected of a person in your position in relation to the company. Then, your skills must also be exercised in relation to your knowledge and skill and experience. So if you're an IT guy, for example, and there's an IT problem in the company, you're expected to know more than your other directors in IT. Or you're a finance guy in a company, you're expected to know more finance than other directors of the company. So therefore, your responsibility is actually a bit higher than other directors. So that's why, in fact, boards, when they look at skill set, they look at different skill sets. So if you are put in the slot, say legal, for example, you should know a bit more law than the rest. And your responsibility in the legal slot, basically, is tested by the second limb. So some directors, because of their specific expertise, in fact, should have higher responsibility than normal other directors. It also means, of course, that executive directors, because of their special knowledge of the company, they have even higher responsibility. So that's how, in fact, the new law differentiates between different levels of responsibility. But there is always a basic level. And the basic level is that every director should know sufficient amount about the company to enable themselves to carry out their duties. Now, that is the basic responsibility that we have in the new law. Now, that has not been sort of very clearly defined in a lot of case law over the years. And we have a tremendous amount of company case law in many countries. But this basically captures nearly some of the high points of the case law around the world. Now, the second issue, of course, is this, all right, then you have director's responsibility. Then what do you mean, therefore, at the end of the day? How do you carry that out? Nowadays, of course, the stock exchange requires every board to do ESG reporting, which is, of course, environmental, social responsibility, governance reporting. Now, ESG reporting, therefore, cannot be just a paper exercise. It has to be a very well thought out exercise that directors themselves have to join in terms of the agenda that they place, in terms of the three trends that I'm talking about, and in terms of programs within the company, which are devoted, in fact, to catching, in fact, these three trends to ensure that the company do not get into trouble in the future, and perhaps even be an exemplar for others. That, I think, are the sort of challenges which place before us. But that's really the responsibility of directors. But then what about the legal and regulatory system? Now, at the moment, in the legal and regulatory environment, it is very regrettable that in Hong Kong, there are very, very few private law procedures to deal with corporate abuses in Hong Kong. Very few indeed, in fact. So you can feel a little bit happier. In fact, if you're a company director, a Hong Kong company, you don't have class actions, so people don't chase you with class actions in Hong Kong. And listing rule breach is a slap on the hand, basically, just a public reprimand, basically. So really, there's sort of very few. But, of course, the SFC, of course, has been doing what the legal system cannot do by way of Section 213 and 214 of the Securities and Futures Ordinance. 213 Ordinance, I'll give you an example, the Hontex case, which is a case where there was some false reporting in the prospectus, and the SFC used Section 13, in fact, to freeze, in fact, all the IPO proceeds. And they were able, in fact, then to make the company return the IPO proceeds to the minority shareholders. And that was a successful case. There were a few cases, for example, like the Gourmet case, where I think Mr. Wang Yu and his wife, for example, is accused by the SFC of having done a deal which could be seen to be a breach of fiduciary duty, and they used Section 213 to ensure that Mr. Wong and Mrs. wife then paid back, in fact, the company, and therefore really sort of settled the case. So essentially, we do have here a public organization, at least because of the problems, and I was saying the scarcity of legal remedies available to the private sector. You have at least a public organization coming through to help investors. I think without those two sections, without the SFC, then we'll have, in fact, a market which would be, I think, probably more Wild West than the Wild West. I think it would be very, very difficult. We do need to have enforcement, both in the private sphere and in the public sphere. Now then, it raises one question. It means that the enforcement efforts of the SFC will actually have to be effective. Now, the effectiveness of the SFC's enforcement methods is dependent upon two planks, two very important planks. The first plank is that the SFC is reliant, because so many companies are in China, they are reliant on the CSRC to help them investigate wrongdoings in companies. Without that, in fact, there's very little they can do. The second thing is that the SFC relies, in fact, on effective coordination in its regulatory functions between its own regulatory functions and the regulatory functions of the listing committee and the listing department of the Hong Kong Stock Exchange. Now, those are the two important planks. Without, in fact, these important planks, we will not have effective regulation. Now, the first important plank has been, I can see, for example, in the last year or so, quite a lot of improvement. I think mainly because I think the SFC has recruited senior staff who are very good at doing liaison with the CSRC, and therefore I can see an improvement there. Now, the second thing, which is the effective coordination, seems to have run into trouble at the moment. Even the consultation paper seems to have run into trouble with a lot of people, in fact, saying that it's not the right thing to do. Now, I have to say that I have come out in support of the consultation paper, mainly because I can see that it is really an effort to try to improve the coordination, without which, in fact, we will not have effective enforcement in the securities markets. I would just like to answer just a few of the criticisms that have come up in the market. Now, there are certain comments. The first comment is that this is a power grab by the SFC. Unfortunately, that is not so. Although all organizations would love to have more power. But this is not a power grab, mainly because the SFC already has, in fact, that power to regulate the stock exchange in terms of its listing procedure under Section 19 to 36 of the ordinance. The other thing, which is perhaps more important and more insidious, is the suggestion that the SFC, if it's more involved in the regulation of the market, might be so aggressive that, in fact, it would then stifle innovation in the markets. Now, that has been articulated many times by many people, many of whom I respect greatly. Now, that is a perception which is difficult to correct. But I think, first of all, I would say it is, first of all, just a perception. And secondly, the SFC is not supposed to stifle innovation. Because if you look at the SFC's ordinance, which is Section 6.2 of the SFO, the SFC, in fact, when it exercises its powers and it undertakes its functions, it has to have regard to the international character of the market in Hong Kong and its status as a competitive international financial center. It has to facilitate innovation, and it has to facilitate competition. Those are the three things that the SFC can do. Now, if people are saying that the SFC is stifling innovation, then the SFC should be reminded of these three particular functions that they have to perform. But I see no evidence that the SFC, in fact, has deviated from these principles. And in fact, even before the SFO was enacted, when I was chairman of the SFC, I have made these principles already part of the guiding policies of the SFC. Not only myself, in fact, my predecessors have done the same thing. And I have seen, in fact, my successors are also doing the same thing. You can see, for example, like the mutual recognition of mutual funds. For example, that is a market innovation. Facilitation of Stock Connect, that is a market facilitation. So therefore, really, I would think that the SFC is not hell-bent on aggressive enforcement which will stifle innovation. But then that requires, in fact, a dialogue and a constructive dialogue between the market and the SFC. And I think this consultation paper and the forum that this creates in terms of listings and coordination, if more discussion could be given on how to making it more effective, would probably be the best forum. So that is what I would say in relation to the two trends and effective regulation. But I see, if in fact we have effective coordination, we can think in terms of the many exciting things in the future. For example, that we haven't quite looked at, for example, different regimes of listing, such as premium listings, standard listings, as the London Stock Exchange has done. that if we have different regimes of listing, we might be able to actually take people with different kinds of stock voting structure into our listing structure. The other thing, of course, is that we should review our REITs regime as well as a business trust regime. Singapore is catching a lot of our business in that area. And also, far more importantly, we should think of new innovative listing regimes for financial vehicles, which will definitely come out from the One Belt, One Road initiative. So these are the sort of important initiatives that only, in fact, an effective coordination machinery can create. So these are what I have to say. Thank you for your patience.